This is Ken Boyd, the owner of St. Louis Test Preparation. This is our website, stltest.net, where you'll find links to all of the dummies books and also help on tutoring services and links to all the YouTube videos. So I wanted to talk about a consolidation problem today in two parts. The first is calculating the differential, and the second is how do we account for intercompany sales of inventory. So we'll start with the differential. So Packard, a parent, buys Stackner, a sub, buys 80% of this company for $350,000 in cash. So the first step in determining differential for consolidation is we determine the total value of the sub based on the price the parent paid and the percentage of the company that they bought. So we take the purchase price, $350,000, we divide it by the percentage that was purchased, 80%, blue divided by green, and we get $437,500 as the total price of 100% of the sub. The journal entry that the parent makes, Packard in this case, we debit an asset account called investment in sub, $350,000. We credit to reduce cash for the purchase. So there's the entry to recognize the purchase of 80% of the sub. We can then go on and calculate the differential. We start at the top with the fair value of the entire entity, which is the $437,500. And then in the middle, we put the book value of the assets that we acquired, or in other words, the equity section of the balance sheet of the subsidiary, which is the common stock plus additional paid-in capital plus retained earnings for a total of $215,000. The difference between the fair value of the entire sub and the equity section, or the book value of the sub, is $222,500. Now, differential is a temporary account that doesn't make it to the financial statements. All this balance gets reallocated somewhere else, and it gets reallocated to two places. The first is we can reallocate some of this money to the fair value of the specific assets we're buying from the sub. That's one place it goes. And if we pay more than the fair value of the assets of the sub, that amount gets posted to goodwill in consolidation. So a chart that I like to use, you may have seen this before, is I start with the fair value of the consideration, a business law term, the amount that we pay consideration, $437,500. Here's the book value of the assets, which we got from up here. And then we also look at the fair value of specific assets. So in this example, the fair value of the buildings is $75,000 higher than book value. The fair value of equipment is $60,000 higher, for a total of $135,000. So I'm going to add the $135 fair value to the book value, and I'm going to get a total of $350,000. So that's the fair value of the net assets, and I put that in green in the middle. So to wrap up differential, $135,000 is going to get posted to a higher value for the building and a higher value for the equipment in consolidation. And the remaining difference between the fair value of the sub, $350,000, and the amount paid for the sub, $437,500, that $87,500 gets posted to goodwill. So what we did in this problem was account for a differential. What we do in the next template is removing the impact of an intercompany sale. And specifically what we need to remove in consolidation is gross profit on the intercompany sale. And we're also going to remove the excess inventory value that we assign because of the intercompany sale. Very important, it's the same treatment regardless of whether the parent sells to the sub a downstream transaction or sub sells to parent upstream. Because in consolidation, we want to only have gross profit, only recognize gross profit from sales to third parties or outside parties. We eliminate transactions between parent and sub. So how do we do that? Well, we set up a T account for those intercompany inventory purchases, and in this case, Stackner's buying from Packard. So here's the inventory account for the intercompany. Beginning balance, purchases during the year from the other intercompany company, in this case Packard, and an ending balance. And we can use those figures to compute the amount that was sold during the year. Beginning inventory plus purchases less ending inventory equals sales, a little manipulation of the basic inventory formula. Blue plus green minus purple. I also have A plus B minus C. That's the amount that was sold to the outside world. Now, once it gets sold to the outside world, we do not have an intercompany issue anymore, so there's no impact on the consolidated financials. What we do have to worry about is what's in beginning inventory, gross profit, and what's in ending inventory. Gross profit's 30% in this case, so if I multiply 30% times 15,000 beginning inventory in blue, that's $4,500 profit in beginning inventory. I do the same thing with ending inventory. $20,000 times 30% gross profit, $66,000 gross profit in ending inventory. So the last thing is, well, what do I do to get rid of it in consolidation? Well, the part that applies to beginning inventory happened in the prior year, and that prior year net income's already been closed. So we need to reduce profit by debiting to reduce retained earnings for prior year stuff. We credit inventory because inventory is too high on the books by the amount of the gross profit, and the amount is $4,500. Debit retained earnings to reduce it, credit retained earnings to reduce, credit inventory to reduce it. We've removed the gross profit and the inflated, too large, beginning inventory due to the intercompany sale. For ending inventory, that actually happened during this year. Net income is being closed. It's still an account we can post to. We debit to reduce net income $6,000. We credit to reduce the value of inventory $6,000. We've removed the gross profit and the inflated ending inventory for the intercompany sales for the ending inventory. So two different transactions, one affecting retained earnings, one affecting net income. Those are the elimination entries, and that's how we deal with an intercompany sale so we can consolidate the financials. That's as far as we'll get for right now. Remember that stltest.net. We have links to the books, help with one-on-one online tutoring, and also links to all the videos on YouTube. Thanks very much for watching, and we'll see you next time.